Hello, everyone, and good morning. My name is Greg Firman. Now, what we're looking at here today, today's webinar is going to be Intermarket Analysis Weekly Outlook, trading intermarket correlations and why they trump conventional indicators, supply and demand basics combined with intermarket analysis, price action trading and ignoring the noise, using conventional indicators in a very unconventional way, combining lagging and leading indicators to confirm price and direction, and a review of the major pairs and how to trade them, along with critical yearly price pivot points to again help weed out the noise. Now, again, my name is Greg Firman. I am Series 3 Commodity Futures and Series 34 Retail Foreign Exchange licensed and registered with the Commodity Futures Trading Commission as a CTA. I've been a market analyst for Trader Planet for approximately the last 7 years and a regular contributor here on Fxstreet.com. Now, what we want to do here to get started, we've got a busy 35, 40 minutes. That's usually what these will run. I usually tend to run a little bit longer, but I'm going to try and keep it in my allotted time here. So what we want to do to get started here is we want to look at basically what should we be focused on when we're trading the Forex market. Now, what comes across my desk on a regular basis is single market analysis that traders are looking at. They're trading Euro US, they're trading US Swiss franc, Great Britain US, US Japan, all these different pairs, and that's their sole focus is that single chart. They're not looking at anything else. Okay, so when we look at the Forex trading to help simplify our trading, basically the majority of trading in the foreign exchange market is buying or selling US dollars with, of course, slight variations to that, but predominantly that's what we're dealing with here. So to begin, we're going to look at major market correlations. Now you can see here that I am using the Vantage Point software in my analysis. I'm going to drag this over here, and the first thing we want to look at, because it is very important, is we want to look at that all-important US dollar index. And this is something I'm going to speak for a few minutes about and compare it to different brokers to help everybody understand which dollar index they should be looking at and which ones they shouldn't be looking at, okay? So what we're looking at here is, again, predominantly, since the Fed has come out with the announcement that they were hawkish, they were dovish, now they're hawkish again. We don't know what they're doing. So essentially, we look at the primary ranges that we're trading and what is a driving factor of the US dollar. So if we're trading Euro US long or short, we need to know what the dollar is doing. If we're trading US Swiss franc, that is a Euro US trade. If we're trading Great Britain US, US Japan, these are all affected by moves in either equities or commodities, okay? That's what's happening here. This is the key thing I want to point out to everybody. Now, one of the main drivers right now, believe it or not, of the US dollar index is the European equity markets and, of course, light sweet crude oil. This is something I work on with my own direct clients on a regular basis. Now, we can see that basically as the US dollar started to sell off right here, the light sweet crude oil immediately started to gain strength. But if we look at where we on a top so far of the year, we're above the yearly opening price, but not by much. So the main thing I want to point out here is the intermarket correlation, that before you take a long or a short on the US dollar, there's a couple of things here that you should be looking at. And I don't mean Fibonacci or Elliott waves or a bunch of different moving average crossovers or anything like that. We have to look at the actual intermarket correlation so we can assess from here that as light sweet crude oil or as the dollar begins to sell off, if oil starts to rally, then there's probably going to be a bigger sell-off in the dollar and a bigger rally in oil. And that's what's happened over the last week. But the key thing I want to really point out here too is that we can see that using the Vantage Point intermarket analysis software, I can see that as the DAX 30 starts to move lower, or the CAC 40, you can look at any of the European equities, but the DAX is a big one. You can see that the dollar is absolutely 100%, nothing's 100%, let me retract that. It's 90% correlated to the dollar index. So when I look at this, you can see that any slight recovery, in the European equities, we can see that the dollar starts to either move higher or lower. So right now, as the European equities come under pressure, right in this area here, they're both moving up or down essentially at the same time. Now, this is largely driven by the ECB and the QE program. That means euro down, equities up. So we can actually gauge how the dollar is going to do by the equity market, the European equity markets. This is just a 3-month window that I've put up here. We can see that as we see a big rise in the DAX 30, the US dollar index basically almost tick for tick is following it. So nothing's 100%, but it's a strong, very strong 90%, just to keep that in mind. Now, the S&P 500, yes, we should be looking at that also. As the correlation is strong to the DAX 30, the correlation we know going back from 2008 is basically the S&P 500 down, US dollar index up. That's been the correlation, but that's not really the correlation right now. Predominantly, we can see a very similar setup here, that as the equities move higher, the dollar moves higher. Now, we saw a pretty substantial sell-off on the S&P 500. A lot of people, a lot of analysts were talking, saying the S&P 500, if we get to 2110, we're going back up towards that all-important 2119 area, where I was just advising my guys were selling because the dollar is going to sell off. The dollar is already starting to sell off. So if the dollar goes lower, right now the S&P 500 is unlikely to make any gains, and that's basically what happened. It took a big hit Wednesday, Thursday, and Friday of last week. So there's a dual trade here. The guys that are on here that are doing futures, or some of your equity futures, there's a dual trade where if you know what one is going to do, you know what the other is going to do. So when I look at gold prices here, gold is another big one, right? We can assess that essentially as the dollar goes up, gold goes down. Very important. So I can mix and match this however I choose, but the main thing is we want to understand what these correlations are. So no matter what indicators you guys are using, all of that is terrific. Just make sure that you are not solely dependent on any indicator. Okay, that's very, very important, that you're just simply checking. Knowing your intermarket correlations will allow you to either buy or sell Euro US, US Swiss franc, Great Britain US, US Japan. It will allow you to trade those pairs far more effectively than what probably you currently are. And the reason for that is that one market drives another. These markets are globally connected, and I cannot stress that enough. So if you're looking at what appears to be a great buy signal on Euro US, but you notice that the European equities are moving lower, not higher, then you probably shouldn't take that long trade. So when I look at that, I can come back here and I can actually specify this to a specific pair before I go into my main chart analysis here. So if we look at the Euro US, I'm going to bring this up so everybody can see it. We're over here, Euro US, okay. So we bring that up. Then I'm going to go over to our main chart so we can understand that. So right now, we can assess that if we're buying or selling US dollars, we need to be looking at oil, we need to be looking at gasoline contracts, right? And we need to be looking at the European and to some degree, the North American markets. This is very important. We also need to identify the current ranges that we're dealing in. So if I'm looking at this, one of the main platforms that I'll use, that I'll set up my own clients on, we do not trade on this platform. It is solely there for doing analysis. I'll use the Windsor broker. Now, you'll notice I have the US dollar index on here. We can get this free futures contract, which is very, very helpful because we can see what the dollar is doing in real time. Now, in a comparative analysis here, I can say, okay, well, Fxcm, for example, and a number of other brokers, they all offer something what's called the US dollar. Now, here's what I want to point out to you guys, the flaws in these two. The US dollar index, some people will say, is antiquated. That's just not true. The euro, 65% of the dollar index is the euro. So how could it be antiquated, guys? We got to use common sense here. If any move in the dollar index is going to affect the euro essentially immediately. So when I look at this, we can see here, this is the Fxcm dollar index. Now, the first thing I want to point out using the daily time frame here is that this shows a new high with this particular dollar index. Now, Fxcm's argument and some of the other brokers are, they're saying, well, we're going to take into consideration some of the other currencies like Aussie and New Zealand that aren't in the DXY. Well, Aussie and New Zealand are not big movers here. So the point being that this is saying that we had made a new high. This is also saying that we had a trendline break, and on this dollar index that the US dollar is actually very, very bearish. Now, when we bring up the US dollar index on the window, which is the DXY futures contract, it paints a very different picture, doesn't it? Excuse me. Now, what it's painting is, first of all, we didn't get a new high on the real dollar index. We're still in the same range we've been in. The thing is, we don't have a trend line break. We're still within the primary range of trade. That's it. So that immediately tells me there is no breakout scenario on Euro US. There is no breakout scenario on potentially US Japan, Great Britain US. The dollar is still in a very bullish uptrend. Now, these bullish cycles in the dollar, statistically speaking, they usually last 7 to 10 years. We're actually about 3 to 4 years into a bullish dollar cycle. Okay, that's just a statistical fact. You can agree with me or disagree with me, but I'm saying that currencies move in the form of a pendulum. So one of the questions I have on here from MRC is how do you draw the trend lines? I'm coming to that, MRC. That's a great question. Why I'm here, I'll touch base on this. What I'm looking for in these particular trend lines, when I draw them in here, I'm looking for a low point. Okay, so I'm going to identify two of these points right here and right here, so we make sure we understand. I'm looking for two candles to the left and two candles to the right that are higher than the lowest point. This creates a demand line right along this area. Okay, same thing up top. Okay, so I'm looking for a high point here. All right, and then I'm looking for two candles to the left and two candles to the right that are lower than the highest point. So this gives me my supply area, which is up here. This is supply, and demand is down here. Okay, if there's demand for price, price goes up. If supply is filled, price goes down. So this is a very simple, effective concept. Now, what's interesting here is that we haven't even come down and tested this area. Okay, and the other lines on the screen that you're seeing on here, you're absolutely correct. Basically a fractal point is one way of drawing a trend line. The key thing with fractal points is what I find the most interesting about them is that they identify an area of whatever happened in the market. Something happened around these candles that forced the market to pause and go higher, but effectively you have a higher low. So you have a low point right here. So let's go back to this again so we understand this. Okay, so you have a low point here. The market goes back up, but then it comes back down, but this low is a higher low. This then creates a trend line, right? So a lot of analysts, and I'm not saying it's wrong, I'm just simply saying how I do it, they will draw trend lines going back 5, 10, 15 years, and they will simply take a high point, a low point. I don't get into doing things like that because with all due respect, the fact of the matter is we're not in 2007 or 2006. A lot of things have happened. We want to keep these trend lines fresh. We want to know where supply and demand is, and we want to keep it fresh. So in this particular case, we can see that looking at the $2 index, one being offered by a broker and the other one, they're both being offered by brokers, but one is based on the actual DXY futures contract. And you can see that it paints a very, very different picture. So the people that are potentially getting short the dollar again this morning, they're in a little bit of trouble here. They think that they're in a breakout scenario because this trend line based around the US dollar index as created by Fxcm, that this is a clean break, when in actual fact it's not. Potentially it's nothing more than we're just sitting in our regular weekly or monthly trade, and you can see we're already starting to move higher off this base trend line down here. So drawing the trend lines are very easy. There's lots of indicators out there that will automatically, free indicators on MT4 that will draw them on there for you automatically. That's what I have on here. Because again, I don't want to have to redraw everything on because from here I can go on multiple different time frames, and that trend line just stays on here. And again, if we look at this trend line on a weekly time frame using the Windsor platform and the DXY, it's a very steep trend line, but they're respecting it. The bottom line is they are respecting this trend line, and you can see that I have a fractal point, which is a fractal point basically is the point where you'll draw a trend line from. you're just drawing it from right to left, not from left to right. Okay, so we're taking our trend line and we're looking for a point here and then going from the right side of the screen to the left side of the screen and matching it to a previous low, but it's based around current price. So if you look at everything we've been through from 2007, 2008, 2009, I'm not interested in drawing trend lines from back then. It was a financial meltdown. We're lucky the financial industry is even still in place after what the Americans did, with the financial breakdown and everything else like that. So these are things we need to consider. We want to look at current price. So from here, we want to then go in and look at our currency pairs, because I want to make sure I try and get as many of these currency pairs as I can and do some solid analysis here for you guys for the week. So when I look at this right now, the Euro-US currency pair, we can see that we're trying to get a makeshift buy signal here, but it's really struggling. But the reality is that you can see that as gas and oil, RBOB is gasoline. If you don't have this chart, just Google it. You can see if it's having an up day or a down day. If gasoline contracts are having an up day, you're a buyer of Euro-US. If oil is having an up day, predominantly you're looking to buy Euro-US, because that's the correlation. When we look at again, the equity markets, and this is another thing, and I see that the equities are turning around today. But last week, this was a fairly easy trade. With my own direct clients, all I did was put out basically longs on Euro-US without even necessarily looking at the Euro-US chart or any indicator on it. Okay, and the reason I'm saying that is the correlation here is virtually 95%. As the DAX 30 moves lower, Euro-US moves higher. This has been going on for a considerable period of time. There's a little bit of choppiness because of the ECB. Right here, you can see, but predominantly one goes up, one goes down. So if you're not looking at the DAX 30 and understanding what's going on with the QE process with the ECB and the potential for the Fed moving out of QE and into a rate hike, I don't think there's going to be any big rate hike, just to get that, sneak my 2 cents worth in on that. If there even is there's a 90% probability the U.S. will hike, but it will be very small. But the fact of the matter is the ECB is not hiking for a long time, and they're buying up debt just like the U.S. was. So we know that when the U.S. did this, that's how the S&P 500 got to where it is today, guys. It didn't get there based on earnings, that's for sure. It didn't get there based around anything else other than the fact that the Fed was artificially propping up the S&P 500. So now the ECB is saying, hey, it's our turn. So now their equities have been going through the roof, basically for the last, 6, 8, 9 months. And the Euro-US is getting absolutely killed. There's an answer. There's a reason why that's happening. This is going to continue to play out. So this section up here that we're looking at is very, very important that we understand that we're looking at the European equities before, not after we take a Euro-US trade. Okay. And once again, gold is another culprit here. We want to be looking at gold if we're trading the Euro-US pair. You can see that gold is effectively stalled in this very tight channel. I'm more interested in trading gold here and here once I get a break of this area right in here. That's important. Now, the other thing we want to look at the Euro-US pair is we want to look at the dollar index. Is the dollar index bullish or bearish? It's indisputably bullish. This number right here, 90.64, the yearly opening price for this particular index. It's never been below it, guys. Never. So if we're talking about a year-over-year gains, and that's what I always look at, year-over-year gains, every January 1, I start a new document and say, okay, am I bullish this year? Am I bearish this year on the dollar? Right now, I am bullish as long as we stay above 90.64. This trend line helps me with this. This fractal point helps me to understand that everything in this picture, there is nothing bearish in this picture. Is the dollar going to sell off every month? Of course it is. That's what it does. You have institutional buying and selling, okay? And, usually around the 15th of the month. And that's why with my own direct clients, we were only selling dollars last week, because somebody big every month is selling dollars, needs to sell US dollars around the 15th of the month. Between the 12th and the 18th, the dollar is usually at its weakest point throughout the course of the month. However, towards the end of the month, the dollar repeats the same cycle and starts to strengthen again. So the people that were selling it at the middle of the month, They're buying it at the end of the month. This is what currencies, people think that currencies trend so much. They don't. Currencies move in the form of a pendulum. And a pendulum is very slow, and it goes all the way to one area, then it goes all the way back to the other. Is the euro US going to go back to 140? Of course it is. So these are the things, but it takes months, years for this to happen. But it just keeps going back and forth. The monthly cycles are very, very important on this. So when we look at euro US, we want to look at this pair a little closer here and understand what's actually going on with this pair right now. Is it really bullish or is it really bearish? Well, that's what we have to look at. When we bring it to our D1 time frame, this looks exactly the same as the dollar index. It mirrors it. We have got trend line support, just like what I showed you on the DXY. We have a range top around the 110, 110.50. We have fractal areas that are coming in to the 110.50. Now, with Euro US, if we can break through here this week, what are we going to need for that to happen? Well, we have to break through this fractal area. We have to break through this trend line. That's going to open the door to this area up here. If we break the downside, then we're going to go lower down here. So these are the things we're looking for, is to understand that we are still very much inside this trading range. Nothing has changed. They're talking about the Fed. They're talking about CPI. They're talking about U.S. retail sales. It's noise. It's all noise. Okay. The thing that matters right now to people is interest rates. The ECB is not hiking. We know this. So for the euro to get back up above 110, 111, this is going to take a lot to get above there, because in the next 6 to 9 months, nothing is going to change with the ECB. Absolutely nothing. So the fundamental there is it's still dollar longs. It's just picking the right time of the month to do it. That's the key thing I want everybody to understand, and to check those intermarket correlations. If you're checking those intermarket correlations, then you'll know that basically very little has changed. Now, we are moving a little bit higher in oil. Oil is starting to push higher. This is something that has my attention, because we can see that the yearly opening price on oil is approximately, somewhere around that $52, $54 a barrel. We'll just put it in there. On the daily time frame, we've got a trend line break here. Okay, we are firmly above the yearly opening price. This is a concern for me for dollar longs. Can the dollar and oil move higher together? In the past, they have, but it's a long time ago, pre-2008. So when the financial crisis came in, equities, oil all went down. So we can see a little bit of variation there. But the bottom line is oil going to keep moving higher? Potentially, yes, it could. But I think its lifespan up in these upper areas is very limited. I think that everybody's getting accustomed to lower oil prices. I don't think it's going to have a big effect on what the dollar does, but it could ultimately have effect on the euro. So with the euro, we need to know the key levels where to trade them. So right now, when you read one site is dollar bullish, the other one's dollar bearish, the other one's euro positive, euro negative. Just get your head out of this stuff. Ignore what they're saying. Because if you do, you're focused on their opinion. And even right now, I'm not putting my opinion onto this chart. I'm simply identifying what the chart is saying. That's the big difference between probably me and a lot of other analysts, is I'm not saying do this or do that. I'm saying the market is ultimately going to make the decision. I just have to decipher what the market is about to do. It's not a rational place, guys. The market is not a rational place. That's a reality. So whether we like it or not, and last week, I don't particularly like selling US dollars right now, but I have to advise my clients we are selling US dollars, because the fact of the matter is every month, 10 of the 12 months, the same thing is happening, right? The very, very same thing is happening all the time. So we're just repeating that process, understanding how the currencies move. The next move on Euro US, where is it going to be? Well, we can see that it's trying to turn bullish here. It's pushed above the weekly trend line. Oil is moving higher. That is consistent with we should be moving higher on Euro US. And we're moving back and forth today. We can see the price is coming off down around that 107.12 area. It is still ultimately moving higher. But this is an equity-driven trade. The equities have to recover in order for if the equities recover, then Euro US is not going higher. It's going lower. Okay, what is gold doing today? That's a key thing. When we look at the prices of gold, has anything really changed on the price of gold today? We're still in that same range, guys. Nothing has changed. We're looking at an area between 1223, excuse me, and down around this yearly opening price at 1182. That's the game here, guys. We don't want to complicate that. If Euro US, basically we have a dual trade with gold. If Euro US can take out the 111 mark, then gold will easily hit 1270, 1250, 1290. It's going higher. But the main thing is watch gold as a trigger for buying or selling euros across the board. When we looked at that intermarket correlation, we look at the Euro-US pair and how correlated, basically the euro is the base currency, bottom line, right? So when we look at this, we can see that the euro is highly correlated to gold. So if gold starts aggressively moving higher, you probably don't want to be buying US dollars. So that means we don't want to be selling Euro US, we want to be buying it. Towards the end of the month, that's what I believe we'll be doing, maybe even towards the latter part of this week. But I'm not convinced right now is necessarily the best time. It's a decent time, but we have to be careful. And of course, that all-important equities. If the equities can recover, then the Euro-US will remain trapped between 105 and 50. So when it gets towards 110.50, we sit there and wait. We know what to do. But again, if we look at that dollar index from Fxcm, this is not an accurate signal. It's a very short, even though it's on the daily time frame, this chart misses a lot of things that are really going on because it's taking other currencies into consideration and it's not focusing on the primary market, which is the euro. So we've looked at the euro. We know what the euro is going to do. I'm going to try and hit as many currencies as I can in the next 15 minutes. So I'm going to move a little quicker. Okay, so now we come to the pound dollar. So guys, when you're trading foreign exchange, the euro is a euro trade, whether it's Euro US, Euro Great Britain, Euro CAD, Euro Yen, blah, blah. It just goes on and on and on. The fact of the matter is the euro is the player, the main player. The British pound is the main player in any British pound crosspair, okay? But the main place to do the pound dollar, to do the pound, excuse me, is the pound dollar. Every crosspair spins off of this, regardless, okay? So we need to know what is really driving the British pound dollar. So we come to the main, before we go to a crosspair, we have to come to the source of the trade. The source of the trade is the pound dollar. So pound Swiss franc, pound yen, pound CAD, all of these ones in some way or another spin off of this trade. So we need to know what is the driving factor here. Well, right now, the British pound is moving higher. The British pound US dollar, excuse me, is moving higher. Why is it moving higher? That's a pretty easy answer for me to actually give you guys here. And anybody that works with me, they know. We can see that essentially with oil and particularly RBOB gasoline contracts, there is virtually almost no lag. There is a little bit of lag in this correlation at times with light sweet crude oil. Sometimes there is, sometimes there isn't. And that's usually because there's been an outside interference, okay? So when we look at this, there's virtually no lag. As oil started to move higher, the British pound, a day and a half later, it followed, okay? So in this particular case, we can see the British pound sold off right here, and then ultimately oil followed, okay? So there can be a slight bit of lag. Now, oil started to move higher. You know, in April, it was starting to move higher, but the central bank, the Bank of England, basically created noise, and they tried to kill the rally in the pound, but ultimately it didn't work. That correlation came right back. Okay, so as oil continued to push higher, the British pound again recovered, right? So last week, you can guess what I told my guys, we're only going long. Pound dollar, we're not doing shorts, we're doing longs. So, and again, but in order for the pound dollar to continue to move higher, you're either buying on dips or selling into strength. What are we doing here? What do we need in order for this trade to continue to work? We need gasoline prices to continue to move higher. A comical thing, what I do, because I have clients all over the planet, I say wherever you get gasoline every day, try and make a habit of driving by there the night before or that morning or before you're doing your trade, because if prices on gas are up, chances are the British pound's going to be up. So if gas prices are down, then chances are the British pound is going to be down that day. So prices do fluctuate a little bit during the day, but you predominantly know whether gas is moving higher or lower. So if you don't have a fancy RBOB gasoline contract, you can even just Google it, and you can see are gasoline prices having an up day or are they having a down day? Now, what I can tell you is that this indicator of using the intermarket correlation will trump everything on your screen. You could have the best possible setup. I know because I've had it. And all of a sudden, the trade that I took goes horribly wrong. I'm at a perfect Fibonacci level. I'm at a fractal level. And I just missed one thing. I didn't check the intermarket correlation and say, okay, the very second I bought the pound dollar, I remember this trade because I thought it was the absolute perfect setup for a trade. And within 15 minutes, the trade went horribly against me. And the one thing I forgot to look at is oil and gas moving up or down? Oil and gas were moving aggressively lower. The inventory numbers came out on oil. The oil inventories came out. The trade went bad immediately. So just understanding that had I just checked the other chart, then I would have known specifically how to trade the British pound. Now, when we look at the British pound, and again, we always have to look at areas that are going to be potentially a problem. You'll see this green line. That's just an average daily true range indicator. You can get that anywhere. It tells you basically the range, the high and the low of the day. The moving average that you choose to use as a pivot area is certainly your call. I have heard just about every number out there. I've heard 10-day, 18-day, 30-day, 50-day. For years, I used the 100-day. Whatever works for you guys. Some people are sold. Ragney Horner, this is the 34. She loves it. Good for her. It works for her. Everybody has their own thing. Whatever works for you. In this particular case here, today, I've got a 50 in there. All I'm looking to do is to determine, am I below it or above it, to help guide me in which way this is going. So we can see with the spike in oil today, this is not a surprise that we have a big spike up in the British pound. So if we cross-reference the two charts, you can see there's your oil chart, right? There's a daily chart. We're having a big green candle up today, right? Does anybody see any difference here between that and the British pound? I don't see any difference at all between the oil chart and the British pound. So one is driving the other. So as I'm looking to trade pound dollar, right, all I'm looking for is an intermarket correlation to say, okay, I've got a green light on oil. When I look closer at oil, I've actually this morning done more analysis on oil than I have on the British pound. I haven't really even looked at the British pound chart until I was ready to take the trade. So I'm looking at this. I've got my yearly opening price. I've got multiple days up. I've had a mixed day on Friday. Friday candles I always tend to ignore. Usually whatever it did on Friday, it does the exact opposite on Monday. That's something to write down because that's very factual. Mondays, same thing. Monday's a horrible trading day, by the way. When you look at this, you can see where I'm having a pretty solid trading day here. I've already come down and tested the average daily range. Whether it's right or wrong, it's debatable, but it's just something to look at, right? If the market believes that, it's just an average 5 or 6 day average of price. So I can look at this and say, okay, this thing's moving higher. So when I look at this, I come over to the British pound on the daily and I can see, okay, I'm moving up on this one too, but I've already moved up. Now I'm moving down. So we're at 149.13. I've got an ADR 148.79. Probably a decent long trade, even right where it is right now, providing oil can continue to move up. I believe it will for now, for at least another 3 or 4 days. So that would put British pound US dollar at this level right now as a long trade, pretty decent trade. But when we're using these trend lines, another very important thing with supply and demand is we want to make sure that we close on the other side of this trend line, 149.61. I believe the market will likely go after this number in the next 4 to 5 hours and try and either close on it, near it, or above it. And if it closes above it, that gives us a green light for tomorrow. But here's one thing I want to point out. When we're looking at, we've looked at combining leading and lagging indicators, but we're also looking at basically yearly pivot points. I don't hear a lot of people talking about yearly pivot points, but they should be. 155.74 is the yearly opening price on the British pound. That tells us how incredibly bearish in 2015 the British pound has actually been. But as we start to move towards the halfway point around June, in most cases, the pound recovers. If it's having a good year, it sells off. If it's having a bad year, it starts to get stronger again. So is it possible we can move to 155.74 in the days, weeks, months ahead? Yes, it is. Absolutely it is. What do we need for that to happen? We need oil prices. We need gasoline going up at the pumps. Right now, the British pound, it's very mixed on their equity markets, but predominantly it seems to like it when the European equity markets are moving up. Or excuse me, the Fxcm 100, which is the UK equity market. So we look at that very, very closely and just monitor it, okay? So we can see that as this one had a sell-off on the day, Friday is not a great candle, period. But the key thing I'm looking for here, not so much in gold. You can see there isn't a huge correlation in gold between the British pound, but there is a correlation. It's worthy of a quick look. The US 10-year Treasury note. Yeah, to some degree, Treasury notes move higher. The British pound usually moves lower. So these are the things we look at and then use multiple time frame analysis to determine, should we be buying or selling? Well, right now, we should be buying. We should be buying the British pound. There's no question about it for the last week or so. But we need to clear some areas up here. We're through that trend line. We need to close above that trend line. We need to get above the ADR range top, 150.49. Pretty unlikely that's going to happen today, I think, but we did hit 149.84, so it's not that far off of it. So it's probably going to gather some momentum and start pushing towards that again. But if we can break through this, we've got a couple of levels up here, get through this fractal point up here, 150, 166. That should give us a green light back between 153.50 and the 155 area. Okay, so that's what we're looking for there. We're looking for a push through this area, a close above this area, and then we can move forward. Okay, now coming into our next pair, I'm going to try and hit the major pairs because try and remember what I'm saying here, guys. We could go through all these cross pairs and everything else, but that's not what we want to do. We want to go to the source: Euro yen, pound yen, CAD yen. Euro yen, they are all derivatives of US Japan, or Euro US, US Japan, Euro US, US Japan, and Great Britain US. That's what pound yen is. Excuse me. So let's try and remember that. So what are we looking for when we're trading this? The dollar index is absolutely a factor. Okay, the dollar index moves lower. Then again, you can see that the yen is moving lower. So right here, and there is very, very little lag time here. In this particular case, it's taking a little bit longer for the dollar index to show that sell signal. But as the dollar yen started to move lower, you could see that ultimately that was putting pressure on the dollar index and it fell. So we need a continuation there. But the key culprit here, the one you really, really want to watch, is the S&P 500 and even more closely is the Nikkei. So with the Nikkei, again, we can get free charts with that through Vantage FX, through Windsor. There's a number of places that offer these charts for free, but you can see that any movement in the Nikkei right here, the market immediately, the dollar yen immediately responds. So the equities are going up, and this is critical to what I'm going to say to you. Before you take a dollar yen trade, you look at your charts, you got a green light from all your indicators. The only thing you have to do is just check the equity markets. Are the equity markets going higher? If they are not going higher, you're not taking a long. You're going to be looking at a potential short. You can see that these correlations simply they're indisputable. So right here, when the dollar yen started to go higher, that's because the Nikkei went higher. So as the dollar yen goes higher, the Nikkei goes higher. The very sell-off in the Nikkei right here, you can see that immediately the dollar yen responds to that. So we have to be mindful of this. If we come to the dollar yen pair, we come to our daily time frame. What has this been bullish or bearish? Excuse me. It's been very bearish, especially over the last week. The yearly opening price, have this on your chart. Okay, you can see how the market has been constantly fighting with this area. We're above it, it's bullish. We're below it, it's bearish. So unless we can get a sustained break of 119.89, then shorts carry the edge. But if we're going to go short, guys, what do we need here? We need the S&P 500 moving lower. It's not moving lower today. It's moving higher, right? We look at the dollar yen pair. The dollar yen pair is moving higher, right? So we come down to 118.53. And we bounced out of there. And the reason we bounced out of there is not because of a Fibonacci level or because we've hit wave 2 of 20 on Elliott wave analysis or any of this nonsense, the equity started moving up. Okay, so again, the intermarket correlation trumps everything on your screen. You could have the best setup ever. All I'm saying is you must apply some it doesn't work. That's not me saying it, that's the market saying it. I'm simply drawing it out for everybody to see that there's a reason why something happens. And it usually has nothing to do with an indicator, a Fibonacci, all these, zigzag I've seen a million indicators, and I've never really seen one that has consistently worked because it's missing some form of, some component is missing. And the intermarket correlation with these live charts set up, they are very, very easy to read when you know. So we always want to look at the higher time frames too. We don't want to be too short term here. So we have a pretty substantial fractal point here at 118.32. Fractal points can be your best friend. They can also be your worst enemy. In most cases, fractal points are counter trend. Okay, so buying off here would technically be counter trend. But if that area holds, then it's a great long. So if I'm going to buy off this area down around even today at the 118.50 area, okay with doing that, as long as the equity markets are going higher. So if I'm going to take a long, would I take a long here today? Yes, I would. I've got the equities moving up. I've got pretty heavy support. I've got the ADR range down here around 118.54. There's pretty heavy support down there. Where am I going to cut this thing? Without a doubt, I will be cutting this thing in this area right here. Not interested in holding it. So short term, longer term, there's a number of different trades that can be taken. MRC is asking, so S&P 500 down, US Japan down. You got it, my friend. That is exactly right. So if the S&P 500 is moving higher, if you're a scalper, or if you're a day trader, or even if you're a medium or longer term trader, that's what you're looking for. Most automated systems, EAs, they all say that my EA works really well. It just doesn't work on dollar yen. And I always kind of chuckle at that, and I'm saying, yeah, I can see maybe that's why, because the correlation is so fast and so hard. It sometimes comes out of nowhere. So you really want to be doing, if you're a dollar yen is not that hard to trade, guys. It really isn't. And it really follows cycles on the dollar index, but it really follows equity cycles. So right now, I haven't checked all my news feeds this morning. I know there's something going on with our good friends in Greece yet again. This isn't going away, by the way. So that could put pressure on equities later today. So predominantly, the dollar yen is still got some work to do with this thing if we're going to go long. So if I'm long here today, we're having a good day, I'm going to be cutting that and taking profit. I'm going to be very, very, very cautious with this particular trade today, because I think it's a very dangerous one, potentially a very dangerous one. So I've got a few minutes left here, guys. We've hit the main pairs, Euro US, Great US, US Japan. 90% of the trades in the Forex market are running off of one of the currencies I just mentioned, the US dollar, the euro, the pound, the yen. Anything else is, it's nickels and dimes. That's where money is really going. So, we've got a couple of minutes here. I'm Canadian, I'm in Canada, this is a pretty decent pair to trade. So let's have a talk about this one, because this heated debate right now about the Bank of Canada. So you guys have the luxury of being on this webinar with an actual Canadian that lives here. I read actually on FX Street, Nomura, I believe it was, the economist, saying they're convinced that the Bank of Canada is not going to cut rates again in 2015. Trust me, they are wrong. They will cut again. The Canadian dollar, the Canadian economy is not in good shape, not by a long shot. All you have to do is look at the last 10 non-farm payroll numbers out of Canada. They're horrendous. Okay, so if you're gauging the employment sector in Canada the same way you do in the U.S., you sure as heck wouldn't be looking at buying Canadian dollars here. So the markets may be overreacted. The one thing I always talk about too on the webinars is the fact that the central bankers are talked out of both sides of their mouth. They cannot be trusted. The same guy that said that the economy, inflation, all this other nonsense talked about, he'll turn around next month and say the exact off, sit and say, he never said that last month. So I'm not saying that's what he's going to do. I'm saying I have seen this movie so many times. I can tell you who the actors are and what they're going to say. Okay. So I'm saying the predominant primary trend in U.S. Canada is clearly up. If you're hanging your hat on shorts because you think that the Bank of Canada, the Canadian economy is doing great and the Bank of Canada is not going to cut rates, Canada should have cut rates 2 years ago. Okay. That, in my respectful opinion, working as an economist, they should have cut a long time ago. And the economy is nowhere near as strong. And I believe that the underlying fundamentals support that. Canada is a commodity-based country. It needs high oil prices. We haven't had oil prices have been on decline for 8 months. Now they're talking about some type of inflation in Canada. I think it's somewhat comical. So these little spikes in oil and gas is going to see the Canadian dollar rise or fall. So when we see, again, these pairs are so intercorrelated. They're based around the U.S. dollar. They're based around oil. They're based around commodities. So when RBOB gasoline, virtually zero lag. When gasoline prices start shooting up, the U.S. CAD starts going down, which means the U.S. dollar weakens, the CAD strengthens. So any pause in RBOB gasoline contracts will immediately send U.S. CAD higher. I don't care what the central banker does. So when we talk about fractals on the RBOB contracts, well, lo and behold, we're coming up to a pretty significant area right now. Okay. So we just have to be very, very cautious with this, and not get caught up in the noise. When we come back to our main charts, we can see here that, yes, I think the market has grossly overreacted to what the Bank of Canada said last week. Okay. And they've just dumped out of longs, fearing that we're not going to hit the 130 level. You've got to take this into consideration. I'd like to answer the questions as I'm going along. Let me get to a few of those. With cable is moat the election breakouts when it reached 142, did not start to recover. What is your midterm view of cable? I don't really care much about the elections over there right now. We're below the yearly opening price, so with cable, the election in UK, not a break on it, getting 155. I noticed that all rallies ultimately get sold. Yes, so Jen's question is saying that ultimately he's correct. All the rallies in 2015 on cable have ultimately been sold. And when you look at oil, look at how many times oil has come up to the yearly opening price and failed. So when oil failed, the pound dollar failed. The elections, I'm not versed exactly on the elections going on in the UK. It's noise. It's largely noise, right? Or it's still, the pound dollar is still being driven by these commodities. It's still being driven by the dollar index. And if we can hold on oil above here, then the pound is going to likely continue to rally, to buy dips, right? And, when you talk about a petrodollar here, the U.S. dollar is a petrodollar, but, it's an inverse correlation. But the petrodollars, in my opinion, were the main correlated ones. You're looking at the CAD, the British pound, clearly. The gasoline prices are drivers of those economies, right? They still are. And it shows in the currency. So before we get into these types of trades, we really need to know that. Okay. So I'm getting the 5-minute warning here. So if you guys have any questions, slip them in now. Okay. Now, another thing, my direct contact information, www.etradefx.ca for Canada, or my direct email, etradefx@gmail.com. Happy to answer any questions if I don't get to them before the end of this webinar. Okay, so these are the key things with the U.S. CAD. So when we come back to U.S. CAD, let's get back into that before we have to wrap up. We want to look at the yearly opening price. So when I pull this out to the weekly time frame, we get a better picture here. Okay. On the weekly time frame, the bottom of that trend line is way down here at the 117, 116.69, and that's where the yearly opening price is. Could we hit this area? Could we hit this area? Never say never, but in my respectful opinion, I think that there's a whole lot of areas down here before then. So if I look at this in the daily time frame, I just zoom this back a bit. My price target on the downside right now is potentially the 119.39 area. I don't believe we'll move past there. I believe the Bank of Canada will turn things around. I believe that oil and commodities in general will start to go sideways again. The demand, the supply is still very, very high in oil, the bottom line. So in this particular week, because oil rallies, is not really about an oil rally here, guys. It's more about the dollar selling off, US dollar selling off. So if the dollar regains its composure at the end of the month, then we just repeat the same cycles. So be mindful of that, of what's going on. These intermarket correlations that I've talked about here, this is what's going to make life easier for you guys. This is one of the primary focus. Then all you have to do is come into the lower time frame, day traders, into your 30-minute, your H1, and identify who's in control of the market, the bulls or the bears. But always check the intermarket correlations first, okay? So from there, I'm going to have to wrap up here, guys. Yeah, I think we've got a new speaker coming in. What I want to do at this time right now is thank everybody for coming out to the webinar here this morning to learn a little bit more about intermarket analysis, supporting me, and more importantly, supporting FX Street. I look forward to seeing everybody at the next webinar. And again, everybody have a great trading day.